Good morning. Lots going on. The U.S. government reopened last week. The next Federal Reserve meeting is December 9th and 10th. It's kind of a coin flip as to what they might do this time. The problem is there are no inflation reports for October, and there never will be because of the government shutdown. We have a jobs report coming out this week in 2 days on Thursday. Could be disastrous, could be very, very disheartening and push the Federal Reserve into a place where they might reduce the Fed funds rate again. Don't know yet. Uh, Today's Monday. Fannie Mae removed their minimum credit score requirement. You no longer need to have a 620 plus to get a conventional loan through Fannie Mae. Now, the thing is, if you have a 620 right now, you can qualify right now, but the rates are terrible. And the cost to get the rate, the buy down cost, is kind of astronomical. I think that might remain the case, but at least it'll be no minimum credit score requirement. So we'll see how it all prices out come Wednesday of this week. So, December 9th and 10th here, if the Federal Reserve holds and does not move the Fed funds rate, would that be good for the 30-year fixed? I think so, because what we've seen the last few times has kept that 30-year fixed sticky. You know, now if the Federal Reserve reduces the Fed funds rate, that will be not great for the 30-year fixed, but it will be a further boon for ARMs that are fixed for the first 5, 7, 10 years. Those things ride along with the Fed funds rate. So the 10-year fixed ARM I'm about to show you would improve by a quarter point or 0.25% in discount, less cost to get a certain rate. So I kind of like that right now. I'm not sure the 30-year fixed is going to be moving too fast until this summer when someone's going to want to win the midterm elections and magically bring rates down. We'll see what happens there, right? Stock market, a lot of instability in the stock market. The guy that did the big short, Michael Burry, also shorting Nvidia and a bunch of the AI companies and coming out saying they're all overvalued by quite a bit. Those stocks are tanking, and those stocks are kind of buoying the stock market right now. Japan has a bit of a bubble happening. Uh, they're having some problems. They own $1.5 trillion in U.S. treasuries. If they start selling those off and dumping those, it's going to be mayhem over here. It's going to cause a lot of interest rate instability. And credit defaults, by that I mean consumers defaulting on auto loans, credit cards, and yes, foreclosures. That's happening a little bit more and more. So we could see the Federal Reserve's hand forth into reducing rates to try to help people out. Where are the rates? These are all bought down to some degree, not a whole lot. The 30-year fix, we can get to 6% on that uh, by paying almost 1% in discount, 0.75%. The 10-year fixed arm still looking fantastic at 5.5%. Yes, that does have a buy down fee attached to it. That's kind of just the way it is, right? 30-year fixed VA and FHA sitting right in the middle fives with minimal buy down fee. That's 0.0025 times the loan amount added to closing costs on those. The zero down FHA loan, middle sixes, depending on credit, 6.5%, but no down payment. And we have the option on the FHA zero down to actually get some extra money, 1.5% of the purchase price to go toward closing costs. So that's a good one. I like that one. Just one rate slide this week, though. Let's talk about a 50-year fixed mortgage. Hearing a lot of talk about the 50-year fixed mortgage. People want to talk about something that doesn't exist and tell people to wait until that thing exists. I don't think it's right. When we talk about the 50-year fixed mortgage, what are we talking about? We're talking about something that's going to have an interest rate attached to it that might just make it prohibitively expensive. Look on this chart here. The 15-year fixed rate is at 5.5% right now. The 30-year fixed rate is at about 6% right now. The 40-year fixed rate, yes, I have that. It's about 6.5% right now. So 5.5, 6, 6.5, 7. That's where I think a 50-year fixed would be if it existed right now. What would that look like? Take a look and see. 50-year fixed, $500,000 loan at 7%. It's about $3,000 a month, principal and interest, $3,000 a month. Meanwhile, the 10-year fixed arm at a $500,000 loan amount is at 2,840. So right now, today, we have something that is, I think, better and smarter than a 50-year fixed loan. We have that right now. But let's take a look at my 40-year fixed, okay? Uh, 40-year fixed interest only for the first 10 years. A $500,000 loan at 6.5% interest only for the first 10 years, coming in at $2,700 per month. Okay, it's an interest only payment. The problem with this one is you have to have a 20% down payment. And that begs the question, people who are really worried about affordability, do they have 20%? Are they 20% down buyers? Not usually. But at least I have it. I do talk to clients about it. I'm talking more and more about the 10-year fixed arm. I talk a little bit about the 40-year fixed interest only as well for people who want something that's going to be fixed. They have a little arm uh, apprehension, and that's fine. So when you talk to people about the 50-year fixed, if they bring it up, maybe something like this would be appropriate. There are options right now that might have better numbers than a 50-year fixed loan. And look at that. She's giving them my card. So let's, it's a great agent right there. My favorite.